Hello and welcome. This is the Mutiny Investing Podcast. This podcast features long-form conversations on topics relating to investing, markets, risk, volatility, and complex systems.
Welcome to part 2 of the special edition podcast, What Happens in Vegas, where Jeff, Malec, and I discuss the EQ Derivatives conference that we recently attended at the Las Vegas Wynn Hotel. I highly recommend you go over to the Derivative podcast and check out part 1 of our discussion. You can find the Derivative on any podcast player. I also recommend you check out our show notes where you can find a link to the EQ Derivatives. It's a tremendous source for volatility, options, and all forms of derivatives trading. With that, let's get on with the show.
Leaders in volatility was
another one after our hearts. So leaders in volatility, monetizing dislocation globally was the title, but we had Will Bartlett from Parallax, Ben Eifert from QBR, Michael Golding from Optiver, and Josh Heller from CIP in Australia.
And literally the biggest swingers in derivative space out there, right?
Exactly.
That's
why they're leaders in volatility is the title.
Exactly. Yeah. Start off. What were your thoughts overall there? Or I'll start off since I have the mic. And I apologize for earlier saying we're not going to go through each panel because that's what we're doing. But
we're skipping a few here and there. So that's if you don't know. Yeah,
we skipped the Bank of America infomercial disguised as a panel.
This is actually, we were talking later about the slides that they start off with the SIBO that we didn't think were necessarily related to the panel. But one thing I'll pull from the slides is they've seen average daily volume, ADV, go up dramatically in option volume that are less than 10 days old. So that was the interesting statistic over the last 5 to 10 years is that ADV is up dramatically on shorter dated tenors in the option space. So that was just one of the things I wanted to point out. And it keeps
average daily volume.
It keeps rising, which is interesting. So you would think you saw that spike due to retail trading options on Robinhood, but it continues to spike, and that daily volume can also primarily come from real institutions, pensions, and endowments that are starting to sell weekly options. And they used to sell more quarterlies and monthlies, and now they're down to really selling that short vol on the weekly options.
Will was saying different than March of 2020. Back then he was getting worried calls, what is happening? And now kind of getting calls, thankful that they have defensive positioning on and that they've covered for this eventuality. And then Ben threw in there over the last year, he's gotten more and more calls, right? Which kind of goes counter to everything you see on the news and FinTwit. Nobody can believe bonds are down at the same time as stocks. He's like, no, I've been getting those calls from institutional investors for the past year, right? That's all everyone was concerned about. Of what do we do if bonds don't buoy the portfolio?
Yep.
And so a lot of those investors are feeling vindicated on using some of these types of strategies as bond replacement.
Yeah. And I think the first thing that Ben said that jumped out at me is that what happens to public markets and volatility when private markets actually finally take a write down, and how that reverberates. Reverberates back through the publicly traded, software companies or tech companies. And then because they're the highest float on the S&P and NASDAQ, do we see a crash in index markets that then spikes, equity volatility?
And then everyone's tweeting about that Wall Street Journal article that private investors have flowed in recently into private equity too. High net worth has kind of dabbled into that. And what does that look like for them as well?
Right. But until, they marked a model. So until they're willing to take markdowns, we won't have it. But I thought that was an interesting way Ben was talking about that reverberation from private to public and then from public into volatility. The other thing to echo that thing that Ben has said, dispersion was great, especially factor rotation, and then averaging out at the index level, and then crowding in long short names. And so just to recap, dispersion trading is when you go short the index vol and long the single names. And so if you have this factor rotation from tech to energies or et cetera, you can see a lot of volatility on those single names, but then it's averaging out at the index level. So that's the idea of dispersion. You're short index vol, long single name vol. And like he's saying, you see a lot of crowding of long short hedge funds that have, relatively large size. You can see a lot of moves in those single names, which is leading to this great trade and dispersion. But once again, I just want to point out, and we'll maybe get this later with Will Bartlett, is just because dispersion has been great recently doesn't mean it's going to be great moving into the future. But that was the interesting takeaway, I think, from Ben talking about dispersion.
I don't even know the answer to this. Can I be short dispersion? It's just conversion, right? Like, so if but would a dispersion trader take the other side of that, right? It went out. Yeah. And now I'm going to bet on it coming back in. I bet a dispersion trader can trade both sides of it. It doesn't just have to be the expansion in the deltas.
There's a lot of nuance there. Like, that's just, it's almost like calling all CTAs trend followers. It's like, it's just the vast majority of dispersion trades short index while long single names, but also you can also be short straddles or strangles and long straddles or strangles, or you can just be directionally short the index and long single names. So it's all, and then you can choose, once again, it's your basket, because the whole point of a dispersion trade is you're not buying the entire 500 names in the S&P, you're choosing which names to buy. So you can choose to try to match that basket vol of S&P, or you can choose to discretionarily choose the actual single names that you want to go long vol on. And so that can affect your P&L quite dramatically, whether you're just trying to play the index dispersion game or you're trying to take single name bets.
You're essentially short correlation, right? So as those correlations return to a 1, but that'd be a whole nother argument we can skip for now.
Well, actually, we'll get into it later. But Michael Golding, so we were talking about, once again, that there's like 4 market makers in electronic option space, one of which being Optiver out of Chicago. And so you had Michael Golding from Optiver there. And he was saying that the vol is supplied, like Gem, echoing what Gem's sentiments were. And then he was talking, that it's all set up on market positioning. But what I thought was really interesting, he's talked about rate vol and how rate vol pairs well with inflation. So as we've seen inflation pick up, then we're seeing interest rate vol pick up. And so that was interesting. And so he's saying, what happens if we come down the other side? If inflation is transitory, do we see a collapse in rate vol? So he was just kind of like, the best thing about like a market maker like Optiver, they don't have any global macro takes. They have no positions, and he kept avoiding all those. He was just talking about what he's seeing on the flow side. And once again, he was kind of talking about that flows over pros. It's like they just, as a market maker side, the vol supply and the flows are what's really overwhelming the markets.
And it's multiple times, like, ask me that question is to ask me where I think inflation is going to be within a year. And I'm not the person to answer that. Right.
Like, and he was just, that correlation between inflation and rates vol is all he's talking about, not saying where he thinks inflation's going. And then, so talk about that cross asset class again, is then Will Bartlett brought up at Parallax that the opportunity has been in commodity vol, and he sees that continuance. So what's interesting is, Parallax trades cross asset class vol, but they also specialize in commodity vol, and they even have specialist pods, even in different forms of commodity vol, from like nat gas vol to oil vol. They'll have even different traders, and they're trading like hundreds of thousands of contracts a day. And so, as we saw people talking about trend following, Will is echoing that, but on more the commodity volatility option side, and that's where they've had really target rich environments where they made a lot of their P&L. And he sees a continuance there. Like you said, he didn't want to bet on the future either.
And perhaps bleeding over, you said, right?
Yeah, exactly.
And then back to Mike, he had some thing of like, which we all do on Twitter and elsewhere, of like comparing the same magnitude sell-off with different, but their vol's different, is quite naive in his opinion, right? Of like, oh, last time the market was down 18%, VIX did this. Last time the market was down 15%, VIX did this. And now why isn't it doing that? It's like totally dependent on market positioning, right? And as a market maker, you can see that. Like, if people need to cover their asses, right, you're going to get a much different reaction than you're getting. So he was saying,
it echoes, what we went back to, like that fixed strike vol supply, right? How have we seen an orderly sell-off and not a pop in VIX? Like, so that goes with Russell Rhodes is saying, and everything is like, and what Jem says and everything is like market positioning. That's what Michael kept hitting on. It's like, this is where the market's positioned, so you're not going to see that movement.
Yeah, and he had 2 examples, 18, Volmageddon, VIX-Mageddon, the derivatives drove that sell-off, right? It was the tail wagging the dog. At the end of 18, within the same year, you had this dynamic. The end of 18, because of the beginning, everything was hedged, and it was a slow grind, even in just 1 month. And it was already hedged. There wasn't any opportunity there. And then 20 was surprise out of nowhere. And even on the way down, there was still the opportunity to hedge. So more and more hedges were getting put on as it was going down.
That's a good point to reiterate. I hate historical analogs, but when we're talking about options, that's easier to do in this sense. Is like you just said, people were hedged in December of 2018. And so what happened is the market grinded down less than expected variance. So if the markets were expecting, 1% moves a day, and the market was grinding down 50 bips a day, you're not going to see a pop in volatility. And that's exactly what we saw in December. And that's kind of what we're seeing in the first 5 months of this year.
The Australian guy, Josh, he was bemoaning and contradicting the other people of like, hey, I have to trade in Australian hours. There's not a ton of liquidity there. especially as you go into some of the, outside of the Russell or the IFA and some of the other markets. And then he had the thing of he's all for these diverging central bank policies because he thinks that's going to create opportunity and create volatility that they can either capture or trade against.
Yeah, I think that was the other big piece of this panel is liquidity. And that was because earlier panels had talked about they, especially the people that represent SIBO or CME, they're there's plenty of liquidity there. And that was Josh's original position is I've never seen liquidity in markets, but that's because I've been trading in Australia most of my career. It's so it's always been a lack of liquidity. But before we get to liquidity, I want to talk about something else that Mike Golding from Optiver talked about with positioning. And he said, and I was going to bring this back around, but I think this is a good time to bring it up. He's saying that a good spot right now they see with positioning is the long dated ball, 12 months out because of structured products. So the banks are selling structured products, and even we'll get to this later. Citio talking about, the US is even starting to outpace Asia and Europe for the issuance of structured products. But because those are typically longer dated, that if you want to buy vol 12 months out is seemingly, a decent price compared to, shorter tenors, less than 12 months. But he also said because of positioning, we're seeing this orderly sell off, but he thinks if we quickly slide down another 10 to 15%, we're going to see an explosion in convexity, just based on positioning. So I just want to reiterate that on the positioning side before we get into the liquidity, because then what was great is Will Bartlett from Parallax was talking about he sees a lot of unseen liquidity traps. And so he was talking about he sees lack of liquidity. You always see people talk about top of the order book or, level 2 order book liquidity. And you and I have argued, yes, that's part of the equation. But now with algorithmic execution, people are hiding orders. So you're not necessarily certain. And I think Ben Eifert echoed this. And he was saying if you want immediate liquidity and you want to hit buy and sell right now in large size, there's scarce liquidity. But if you can work an order, even on listed options, he believes it's very liquid. So if you want to work an order over a day or a couple of days, and you don't have to take that immediate liquidity, he's saying there's a liquidity mismatch there where immediate liquidity is incredibly scarce. And that's what you would see in that order on top of the order book. But he's if you can work orders over multiple days, even in single names, he thinks there's a lot of liquidity there for people that have that ability.
Yeah, I think I wrote down, if you're demanding price insensitive at the market right now, worst it's ever been, he said, the liquidity worst it's ever been for, I got to get out of this right now. Right. Which makes no sense. But I think that's just the gamification of it all, right? Which is to your point. Ben, speaking of Ben, he brought up the European dividends, which he's always apt to do. But he said another piece of this here of talking about opportunity and rates vol and where can you find these, right? If vols all bid, you can't find this opportunity. There's asymmetric payoffs. He said and this tied back to the liquidities, there's constant weird liquidity unwinds, right? And he gave an example in European dividends. Some European bank blew out, needed to get out of all this stuff right away, and it was trading at a huge discount. And they stepped in, bought it up. So goes back to that other panel of the third thing there, an event hedge, right? Or just opportunistic ability to take some things that are dislocated and get involved with a long skew, with a asymmetric type of option profile payoff. So I thought that was interesting. More and more opportunities like that, surprises are popping up globally.
Right. And to echo Mike Golding from Optiver, Ben was saying too, is even on the equity wealth stuff, deep out of money, low skew, convexity is still high on maybe those longer tenors as well. This is not investment advice for anybody, but we're just relaying kind of what the panel said. And then I might be front running you on this, but one of my favorite hot takes of the day is all we heard is dispersion good, dispersion good, dispersion great, everybody. And then Will Bartlett said, dispersion's a bad idea. He's that's where I see one of the biggest liquidity traps and a sharp sell-off. And then you are just circling your point where you had just written down, an hour prior that is the top end for dispersion.
Yeah. Huge liquidity trap. If we go lower than 3,300 in the S&P, dispersion's going to get blown out, is what he said.
Because like you said, short correlation. So those correlations go to 1 in a liquidity event or any sort of bar sell-off.
Yeah. I think that's it.
That's day one. That's day one done. Luckily, day 2, I don't think we have as many notes, so we'll still get through day 2.
Day 2, we were a little tired. Day 2 started out with Ben Hunt, who I'm a fan of, been on the pod. I was a little actually upset because it was all the stuff he writes about and tweets about and puts in his articles. I wanted some new stuff from him, but I understand it's hard to just come up with new stuff for me. So loved his anecdote, which he says all the time of, right, the old fish swims by the two younger fish, says, hey, how's the water? The two younger fish swim a little way, and then the one turns to the other and like, what's water? Yeah. So just his point of like, we're all in this bubble. We can't even see everything that's going around us for what it is, which is all a narrative trying to push us in one direction or the other. And then he had a Claude Shannon shout out and picture, which I thought you'd enjoy. So I wrote that down. But that's basically all I had for Ben. It was a good talk. Anything?
I was waiting for you to ask. I took 0 notes during Ben's talk, and unfortunately, I think I was grabbing my coffee while he talked about Claude Shannon, because that would have been the highlight of my experience. And I have zero issue.
And his whole Claude Shannon thing, was basically just he identified that the noise is an important part of this picture, and you have to. He wasn't just saying ignore the noise to get the signal. He was saying you have to account for the noise. And so that was his main point of like, this is all math. This isn't something new he's come up with. This is all out there. He's just saying our human brains we want to just ignore the noise instead of accounting for the noise.
And for those who don't know, Claude Shannon is the founder of information theory. And Jim Oshak always talks about the Shannon limit. Like, we can only all take in so much noise on a daily basis in our brains. So like, we always reach like a Shannon limit. And I think that's right when I walked in, where Ben was talking about, you have to decipher or reduce the noise to see the signals. And then that's what he thinks he does. And it's not that I dislike Ben Hunt at all. I just think that he's not my particular brand of Fight Club. And in using narrative to talk about narratives, and then narratives, it's like narrative turtles all the way down. And so it's just to me, it's kind of ironic.
I'm going to start using that with my kids when I'm tired and they're saying something to me and I'm just have the blank stare. I'm like, sorry, I'm at my Shannon limit.
Yeah, exactly.
Exactly. See what they say.
So then I would say, I know you were more excited for Ben Hunt. And so then I didn't take any notes. But then in the very next panel was from hedge fund to institutional investors, opportunities in digital assets. So this was the crypto portion. So I would assume I took more notes than you did.
Yeah, I had the wrong pen because I was in the New Morning and it was like cramping my hand writing with that little Win pen. So I had to go back to the good pen. First world problems. Those damn nice Win pens are too small.
So I just have like a bunch of like kind of hot take or just quotes I kind of wrote down. And one of them was starting with Eric Peters from One River, who is claim to fame, at least on the Bitcoin side, was that he was like the first institution to put large size into Bitcoin for his clients. I think it was November 2020. They placed about 500 million into Bitcoin. So that's why he got kind of known in the crypto spaces for that. But one of the things he said that was interesting right at the beginning was that he views future correlations will be dynamic. Meaning, everybody's now quoting that, cryptocurrencies, especially Bitcoin, are correlated with the broader markets. But like he's saying, I always have a problem with correlations as well, because you're always using a time window analysis. So you're arbitrarily picking your time window for correlations, and correlations fluctuate and vary. And that's why figuring out cross correlations or, correlation matrices are so difficult. And then he was saying, even though we've seen it correlated, he expects in the future that the correlations will be very dynamic. And sometimes they'll be correlated, sometimes they'll be uncorrelated or negatively correlated.
It's funny you thought that was interesting, because I wrote down Talking, his book.
Well, of course. Well, that's
right?
That's the entire like, every panel.
Yeah, but it's that especially stood out to me there. Like, of course you're going to say it's not going to be correlated, because to not would be like, this is a hugely speculative, complete risk asset that's like on the to the right of NASDAQ, right? To the right of meme stocks almost even.
Well, if we talk about it too, it's like the entire 2 days, right? Is everybody's always talking their own book, because everybody's like, this has been an organized sell-off, really tough for long ball, says every long ball manager. And like dispersion's been great, says every dispersion manager, right? Yeah. Commodity trend's been great, says every trend manager. So like, everybody's talking their book. And the next one was Derek Devins from Neuberger Berman talked about his quote was, "You don't know how good Bitcoin is until junk breaks." And I know you and I have been having this argument, and what I was more pressing to me when we saw the Luna and Terra sell-off was like, Bitcoin's down, but it wasn't as big as we expected. As all the altcoins sold off 80, 90%, and we've seen this a million times in crypto and everything's correlated, is that we saw like Bitcoin and Ethereum only down, 20 to 30%. So it was an organized sell-off, even though a $40 billion complex blew up, which is kind of impressive in a way. It's weird to say like, the cleanest dirty shirt, kind of thing.
Right.
Like,
well, but you're still alive, Mrs. Lincoln. Right.
Yeah.
So the big thing that stuck out to me here, I'll just go, right. This whole idea. And they kept saying like, this is terrific, we're experimenting with real money. And that shocked me, right? Of like, that's terrific. Like, it's like 40 billion got blown up there. All this other trillion's been evaporated. Like, that's terrific that we're experimenting with real money. That's like frightening to me that we're experimenting. Like, I feel like it discounts all the people who've lost real money on that side. And you can argue like they knew what they're getting into. They're investing in this. You can argue like a lot of them were led to that place with unrealistic promises. But right, that just stuck out to me. Like, right, if we tried to raise a fund like, hey, we're going to experiment with trading crude oil futures with your real money, people would be like, are you crazy? Get out of here.
Yeah, but at the same time, I agree with what you're saying. But people are talking their book. But I always think about it in like Taleb. I think always talked about like we should have like a restaurant owners day, right? Or entrepreneurs days. Like through 90% failure, we as a society benefit, right? We benefit from broad diversification of restaurants. We benefit from a broad diversification of entrepreneurs creating, products or different things to improve our lifestyle. So I think that's more what they're saying, or even in the US, states' rights versus federal rights is like, we would hope that each state actually goes off on their one-off experiments and we see what works and what doesn't work. And so I think that's what they're trying to say is like the amount of ingenuity in space and where it is headed. And yes, we may be losing here or there, but like, do we stumble on to like a new financial system? It's like, I can't stand when the Austrians talk about malinvestment because like one man's malinvestment is the future's man infrastructure, right? Like we got all those fiber optic cables during malinvestment. So like, you really don't know over the long term what's good or bad for us. And then, but like you said, I was at Blockworks permissionless event just a few weeks ago as well. And I thought the vibe in that room would be fairly negative or depressed. But once again, we all have these psychological immune systems. And so everybody in that room was excited. It's like builders build in bear markets. So it's like, it reminded me of the analogy is like, everybody's a trader until they have a losing position, they don't sell. And now they're a long-term investor. And so that's what I was thinking about crypto is like, now that they're in another maybe crypto winter, they're like builders build in bear markets. And now I'm a builder. And like everybody changes their tune once again. But another little hot takes from that were, John Laughlin he's the risk officer at GSR. He said, crypto learns from failure. So you can see how smart it's become. Yeah. So,
that was good.
That was it. And then the other one for Derek Devins, and I can move on from this panel, is that he was talking about, you don't know how good it is till junk breaks. But then he's also saying, reminding everybody that when high yield bond markets started, they're very nascent markets, they collapsed and there's a lot of carnage there. Same with MBS. When it started, there's a lot of carnage, and going to your favorite GFC, that's, you just don't know, is like you have big risks when markets are nascent. And then the extreme hot take from Derek Devins was that Tether is the big winner from this. And I was like, excuse me? But what I think he was trying to say is, if people don't know,
it didn't blow up as well. But yeah,
the Tether didn't depeg. So once again, cleanest dirty shirt is at least Tether didn't depeg in this environment when Terra depegged. But Tether, what he was talking about is like you're going to use wrap Tether to trade with because you don't necessarily, that's a way to rehypothecate and get some margin and leverage if you're actually trading altcoins. And so at the same time, Tether gets stronger, but then, a lot of people would lose their shit and argue the structural weaknesses in Tether, or they would, that's a nice way of saying fraud. So it was interesting to say like Tether is a big winner because if you understand how the system works, if you understand how the system works, you understand why Tether was the winner. But in that crowd, it's audible gasp because they're all of the boomer Bitcoin bear that they think Tether is a complete fraud,
or they're of the, like, I run a $4 billion hedge fund that has to have its financial statements audited by a big five firm, right? Like, so this is the big winner who has no audited proof that they have the backing.
Well, like PEs or VCs, don't we wish we could have self-attestation for even our P&Ls or our volatility? So, and don't get me wrong, I am just as skeptical as everybody else. And I'm very concerned that the only people that can really pull out money out of Tether and size is Alameda and Cumberland. So we really don't know what's legit and what's not in Tether. So I'm not saying I'm pro or con Tether. Probably more, my bias more con, but like, it was interesting. That was the hot take that Tether's the big winner from the Terra collapse.
So I had a few other things here. Everyone's saying it's too early to tell if crypto covers inflation. I can sort of get, but again, talking your book, like, of course, it's too short of a period. And of course, it doesn't. Yield farming is just covered call writing, which I like. It's an easy way to explain that. And then Luna is a $40 billion crater into the lake, which I wanted to say, I think a crater is what happens when something falls, not the thing that falls. But I'll give him, he was live on stage, so I'll give him a pass on that. But saying like he was alluding to, we might not have seen the ripples on the far side of the lake yet. And like calling back to March of 2008, when that first JP Morgan credit fund went bust, right?
Yep.
And we didn't see the lows of the GFC until much later. So he's like, maybe this Luna thing hit now. Everyone was surprised it didn't cause more ripples. Maybe those ripples are 3, 6, 9, 10 months down the road. Yep. And then I got to say, later that night, we were all debating crypto, and I brought up my favorite thing of, all right, we're going to go in the Wynn pool, and it's pointed out to you that there's 10 turds in the corner of the pool. You still want to swim in that pool? To which you say...
Yeah, what is there gold bars in that pool though? So that what risk are we taking? And I think, but you use that for crypto a lot. I think that's the risk in any market. Yeah, all markets have risk, right? Like if you're, long S&P index, like you have an air pocket to the left side, you have a tremendous left skew. So it's just about knowing where your risks are and then position sizing accordingly. Because as you know, I like to bang the drum on is like your only ability for due diligence or managing your risks at the end of the day is position sizing. Because you never know what markets are slippage, you can get in and out. So the real only risk metric we have is position sizing. So if you know what your risks are, then you can position size accordingly.
So you're only going to put a foot in the pool, not your whole body, just a foot, or maybe a hand, so you could grab the gold bar.
If I was you, I'd be figuring out a device to skim across the water and grab the gold bar. You're always trying to find option C, right?
And then the last piece on this panel, I can't remember who was the One River guy. I think he was getting into social aspects, which I thought were interesting. Of like in the 70s, the young people were rebellious and they had all this loud voice, but not a lot of power. It's like young people today, because of crypto and even because of social media and whatever, like have a ton of power. He was talking like these crypto bros, which is used derogatorily, but they have money and they have innovation and they have, they're smart, really smart. And he was kind of saying they're going to change the world, whether we like it or not. Like they're pushing fast and hard.
Yeah, it was actually interesting when I was at the Real Vision crypto event in Vegas last year. That was what I thought was interesting. A lot of the people in the space that are like more Gen X, millennial, 30s and 40s, is they were using their crypto wealth to influence local politicians. So like, that's what Eric's referring to is like, they can, if you've gained all that wealth and then you figure out I can move the market by co-opting my local politician to my side of the equation, we could see a lot of influence there. And what I always wonder is what would be fantastic in my opinion is like, we have this enormous wealth transfer, right? That's got to happen from boomers to millennials or Gen Z. And it could be very violent. Or what would be interesting if we could transfer it via crypto. And by the time crypto markets get institutionally adopted, where then pensions are investing and everything, hopefully the young retail is now selling out. And that was like, and institutions are doing that when stocks and bonds have sold off. And so maybe that's a non-violent transition of wealth that we could potentially see. But, I'm hoping for a Goldilocks scenario there.
Which segues nicely into the insurance panel, where at the very end, actually, the one youngest guy on the stage there said like, "Hey, I think you're right." Basically, everyone else is like, no bid for crypto at these huge insurance firms that are like too new, too risky, too everything, and they're doing big structured products, annuities, fixed index annuities, whatnot. And this younger guy, you're good at the names, I'm not.
Yeah, it's Fon from Beta Investments.
Yeah, he was like, I think there's a huge market here of like basically a fixed index annuity, which says, it's insurance with a wrapper tied to some index. Like young people are probably going to want that index to some crypto, and or their insurance is held in crypto or blockchain. Like what if so there were a lot of interesting theirs, but we'll get off crypto.
This is where this is almost like the most exciting panel for us when our ears perk up is like, what are insurance companies doing? Because they are controlling, trillions of dollars of assets, and where they flow into markets is what's most important to us. And like, Ben Eifert's always been great about this is like, especially whether it's pensions or insurance companies, they're like these enormously large cargo ships. So for them to turn, it takes a very long time. So their flows can affect markets for 3 to 5 years before they move in and out. They're not hot money by any sense. And so they don't have that nimbleness. So you really need to pay attention to, because they have enormous amounts of flows, and those flows can trend and continue for years on end.
And just to give a picture, right? If I'm a big insurance company, I've got tons of premium. I need to earn a yield on that to make the business profitable, but also to have, the money down the line. It's tied to some index. So it not only has to grow, it has to grow alongside the S&P or some other index. So what they were doing 2018-ish, right? Massive sellers of vol. Like, I have a long enough time frame. I don't care if there's one little spike or not. So I can sell all the vol I want, collect that premium, and basically be able to endure a spike. I can meet the margin calls, right? It's like we were talking about in Vegas again, right? They came up with table limits because someone with enough money would just double their bet every time till they were back to even. So the smart people, I think it was in France, actually, not Vegas, but whatever. They came up with table limits to say, we're not going to allow that. We need to be able to lock in our gains. All that to say, the insurance historically big vol sellers, either outright because they have long equity portfolios that are going to be susceptible to spikes in vol, or outright selling a vol to generate yield. So having said that, one of the first comments there from Brog Arwal got it there?
Columbia Threadneedle.
Thank you. Was saying insurance are way down, way lower on their short Vega exposure, Vega being vol. So he was saying he was guessing it's between 800 million to $1 billion, which there were some charts flown around back in 18. I think it was 4 to 8 billion. I'm going to just throw out off the top of my head. Right. Could be off by a factor of 4 there. But
and to clarify on Vega, for every 1 point move in volatility, that means you'd have a 800 million billion to it. It was 800 million to $1 billion, right? Like that was what his quote was. And that's what you're saying. It used to be a lot more. So that's what he's saying. And that was an aggregate, I believe, of him and 2 other insurers. So like he's like, the 3 of us make up, 80% of the market. And he's like,
I think just think about that being short $1 billion Vega. That's just, even though that's
every 1 point move
piece right now. Yeah. Right. So VIX goes from 10 to 20, that's 10 billion off the table.
Right, and that's and to give that context, it was because somebody else was throwing out numbers that like the insurance companies represent, so many hundreds of trillions, and he was like, let's just put it in very specific Vega numbers, and this is for every 1 point move in Vega, we're moving probably about $1 billion. So that gives you a more accurate picture than saying their notional value is like 10 trillion. Like those notional values are irrelevant. So that was interesting, and like that's what he's saying is like, so they're participating less on the Vega side, and they're talking about the clients' portfolios are shifting. And I think this was like LT Grant saying more. They're like LT Grant from Protective Life talking about they're shifting more of just the portfolio construction from being short or long Vega to even just switching to bonds and being more bond heavy. And we'll see what happens in this bond sell off. So it's much more. We look for those institutional flows from insurance companies into Vega space, and that's what they're saying. They've been less interested in the last few years than they have previously. But we'll see how long that takes before, if markets stay calm, they become, big short Vega sellers again in the next, 3 to 5 years.
Right. And that's which you mentioned before, right? That's kind of a premise of some long vol guys of like, there's all this structured product. They're massively short Vega. What happens when they have to cover that? Right. All of this is what can cascade and spike vol to crazy levels.
Yeah.
But to their point, they also mentioned a few times they've gone more into vol controlled products, which is essentially risk parity, more vol targeted products. So they've kind of dampened just that outright short vol exposure was that's the big takeaway.
The side note I noticed as well is like in this industry is like the fucking nomenclature changes every day. Like, and so it's like, vol targeting now, vol control, like all this stuff is just like, you just got to stay on top of it. And there's a lot of acronyms thrown out these things, but the acronyms
this panel was the worst. Yeah.
Yeah. Like difference in insurance space versus regular space. Like, so it's just crazy. But the one hot take from Braj that we were like, what was he said, your hedging and your model portfolio is like contingent on which accounting you're using, right? So like you can model your accounting like mark to market on like shorter dated tenors and Vega, or you can use non-GAAP or FIS accounting, and you can mark to model on a 10-year vol metric. So it's like you can adjust your book depending on which accounting convention you want to use. And we're like, excuse me,
right? Yeah, which is like, hey, PE, hold my beer.
Exactly.
I'll show you how to mark this.
This doesn't look good in real time. Let me create a 10-year vol model that then I can use in my accounting for. Another side note was, I think it was LT Grant was talking about that clients are calling them up asking for rate hedges more than he's ever seen in his career. So he's like, is this a top once again for rate hedging. And that's what they were asking. But then the one like you were referencing earlier about, whether you're a casino at Vegas with table limits, I think Emmanuel from AIG kept talking about like he just has a 30-year time horizon. And so he thinks about it very differently. And he's saying, Q1 or Q2 of a market sell-off is not a long enough time frame for an insurance company to change their hedging structure at all. That's going back to this analogy of a cargo ship. And that's what he kept saying is like, 2 quarters, like we're thinking in 30-year time horizon. So this really doesn't matter to us at all. And like I said, they're not shifting, they're not nimble, and part of that. But that speaking of the 10-year time horizon, that was another thing that they brought up is like historically they used to trade a lot of like 10-year VAR swaps, like pre-GFC. And now we're seeing like they're all coming all the way down to like 2 years out and trading more like listed exchanges. And part of it is like the new they talked a lot about, and maybe this is a part that, was maybe deep water for us, is all the regulatory changes in collateral requirements for insurance companies. So that was like a lot of the panel. And that's why they're talking about like now you're seeing people move from OTC over the counter, counterparty risk with banks and to get a 10-year VAR swap is now they're moving like to 2-year options within listed exchanges. So that's why we're seeing there's a general push from the exchanges, and obviously people speaking their book on exchanges at the event is everybody like the regulations are pushing people into listed exchanges. And this has actually been Ben Eiffert's contention is like, this is why he wants to participate on listed side, where previously he used to be on more the OTC VAR swap side, is because that's where he thinks the opportunity is. And the money is flowing more into more than a liquid listed exchanges than it is on just being this OTC market.
And the one guy on there was AIG, right? So poster child for
manual.
This should all be on exchanges, right? Like we shouldn't have a bunch of OTC stuff that nobody knows what's going on. But to me, that's also like risk can't be transmuted, right? So where is it going in the system? If you're like, no, all this risk we waved the magic wand, it all came on exchange. Now it's all gone. So maybe it's in that accounting convention, like, there's no risk here. We just market the 10 years.
That's an interesting argument that actually every like short ball blow up is also an accounting blow up, right? It's always an accounting convention of like, where are you able to hide the risk on an Excel sheet or something?
Yeah. And I don't know, like in 2008, right? They changed the mark to market rules for all the banks. I don't know if that's been rolled back. Someone put it in the comments, whether that's been fixed. Another thing, you basically saying, even though they're long-term, very interest rate sensitive, right? And he said they've become, with rates so low, they've become like Japanese auto callables, which I didn't quite understand. Maybe you have more color on that, but maybe not.
Oh no, because you're selling the call and buying a put or putting it back to the bank
because rates were so low, you had to generate yield.
Yes,
is what you were saying. Yeah. So he's saying there's some issues there. Just checking my notes. Sorry,
we're selling a call buy and put. Sorry, I said that in reverse.
Yeah,
as my brain's still trying to wake up today. While you're looking at your notes too, I thought the interesting one too, and obviously people speaking their book, the moderator, Damien, was from Eurex, but they were talking about, like we're saying in the listed exchanges, is they're moving from total return swaps to total return futures.
On CME. I know I got that too. I'm like, guys, your panel host is Eurex. Stop talking CME.
Yeah. But that's
he was very definitely brought it back. He's like, and yes, on the CMEs.
Yeah. So they're obviously trying to do it as well in Eurex, but like that is interesting that once again, moving from this opaque OTC market in total return swaps to total return futures. And so once again, we're building out another market on the CME. So we'll see what's the liquidity and size and volume moving forward.
And then I just wrote down, I don't know exactly what it means of the Vega Pac-Man product. So I think that just means massively short vol and just eating up any vol bids, right? Like Pac-Man.
Yeah. And he's referencing that it's more on the 10-year term. So that's what he's saying. Like recently, in the last 5 to 10 years, they moved from 10 years down to 2 years. And that's what the question was, like, when do they move back to those 10-year VAR swaps? And that's what they called the Pac-Man trade. Yeah. We need to get some more color on that. And I think that was the big takeaway for you, is like, you need to get Raj on the podcast because he was fantastic on the panel. Yeah. And maybe he can explain the Pac-Man trade in detail.
Right. I think there's right. If anyone wants to offer me 10-year vol at whatever rate, because no one knows what it's going to be, and my duration's way longer than you, I'm going to eat it up like Pac-Man all day long.
Our buddy Chris Zidio gave a talk that was maybe only like 10 to 15 minutes. So he ripped through it pretty quickly. But it's all stuff we know too. But he was saying, he was trying to talk about, you can fund tail risk with capacity constrained edges. So what he's trying to show in his talk is like, there's a lot of opportunities in low capacity strategies that larger institutions that are running, tens or hundreds of billions of dollars can't touch. And so he's saying you have an uncorrelated way, instead of using like dispersion or highly correlated basis trades, there's a way of using capacity constrained edges to get a little bit of income to help cover the cost of funding tail risk. Now, of course, he gives that presentation, but he's not going to go into detail of what those actually capacity constrained strategies are. But he was giving people some insights. And one of the biggest charts he was showing was about the idea of just daily volatility and showing how that's kind of changed over time too. Once again, we're talking about a lot of the panels, I think, or the overall hype was around, volatility changing tenors, right? It used to be like when insurance side from 10 years, they're coming down to 2 years. We start talking about pensions funds. They were selling, quarterly options, then monthly options. Now they're selling weekly, and probably they'll start branching into daily options. And so, Chris was talking about opportunities on intraday vol. And so maybe if you can figure out different capacity constrained strategies there, that's a way to provide income while to fund your tail risk options. And then the last one before I had to leave for the airport, it was kind of interesting. It was a roundtable kind of discussion with basically, it was called Fireside Chat with Systematic Overlays as an asset owner's perspective. So it was interesting. You got Jerome from Credit Suisse interviewing Powis from UPS Group Trust. And Powis is, he works with our buddy Rockton McNeil. Yeah. And so obviously like UPS to me is like the most sophisticated pension in America. And they even blow the Canadian pensions out of the water. Like what Rockton and Powis are doing there is truly incredible. And I just love always hearing or talking to them about what they're doing. But basically like Jerome's trying to pick his brain for the audience to know how they can pitch products to like a UPS pension. So they're kind of going through that. But I thought
they mainly do it all themselves. So that's a little weird.
Yeah.
Right?
And this was more like an internal takeaway because we always have these discussions internally. So it was interesting if you and Taylor have been around for this because it was a lot more of our internal discussions of how UPS builds their book. Especially Powis is in charge of alternative hedge fund investments. But one of the things he talked about that we've discussed a lot internally is, let's say they're going to give a manager, like they've gotten through all the due diligence process, right? They start with the quant side, like show us your numbers. They dig in the numbers. They start changing parameters, shock testing, see if that'll work. Then they dive into like the due diligence on the discretionary side and kind of walk through that. But at the end of the day, Powis is a man after my own heart. He said, at the end of the day, due diligence doesn't matter. It's position sizing. So if they're going to give $100 million clip to this manager, they're likely just to put in 25 million for the first 3 years, see how it goes, see if they can actually generate alpha, see if they're all on the same page before they re-up that allocation to the 100 million.
Did you have a little like that emoji touchdown hands like, when he said
that? Like everything he said was exactly what we talk about internally. So it gave me confidence. Like that was the overarching thing, is like, based on that event, it was like, it gave all of us a lot of, maybe confidence isn't the right word, but it was like speaking, like you're saying, everyone likes to talk their own book. It felt like they were talking the book for Cockroach for us, right? Like it was all like, broad diversification, diversifiers, all those sorts of things. And like unknown unknowns. And, commodity vol, rates vol, like you need to branch out, take some basis risk, like all that stuff. And like, that's, exactly what we do. So it was like, it was a one big love fest, at least from my perspective.
Yeah, and that there's an unlimited supply for derivatives products, and right, or unlimited demand for them and supply. Like these exchanges, these groups are just going to keep coming out with new, and I think we're definitely going to hourly at some point in the next 10-year hourly options. And even down to like what you're saying, going on to exchange, the blockchain to facilitate some stuff. So like, we're just going to see more and more. And that's really what the conference were like, help people understand these different newer products and how the existing products are being used. Right. It's funny to think of options as a product, right? It just seems like something we're all born with, but right. Somewhere, someone came up with it at the, wherever, CME ages ago. I'm reverting to my futures-based roots, but right. We don't even know this. Where were they first traded?
So options, you can say the Japanese grain exchange in the 1200s, I believe, is what they saw, or like Thales of Miletus allegedly traded options on olive oil presses, and that's where he made his fortune. So, depending, if you want to talk about actual modern markets, is a different story.
When were they first created for profit? Yeah, like for an exchange.
But one of the things is, as we wrap up here, is I hope we gave, as all these events, most the interesting conversations are in the hallways or the in-between times, grabbing a coffee with somebody or whatever. And so I hope we gave some color to that. I wish we gave more, but a lot of these are, private conversations that people don't want to air publicly. But I'm just wondering, outside of the actual talks, was there any other like takeaways or hot takes or any experiences that you thought would be interesting to the audience?
I think the Wynn waterfall that turns into a singing frog was super cool. I hadn't seen that before, so go check that out. I can't remember what it's called. They got a little mini lake. It's like a mini Bellagio show, but more interactive. Yeah,
we're down at like the aft cocktail like pier over that lake, and it's crazy, like the imagination that goes into that. Like a crazy Disney show pops off every 15 minutes or whatever. That's different, and then just to me, the juxtaposition of watching all these sophisticated vault managers we were hanging out with, all shutting up to watch this show. Yeah.
And then as traders will do, we're sitting there looking at. There's this fountain, all this stuff, and tons of trees. Like they basically created a backdrop with all these trees. So everyone starts saying, like, make a market. What do you think all that vegetation costs? I think I was at 20 million. Someone else was like at 2 million. Those aren't all real. So, right. That's it. I think Vegas is back. Seemed pretty busy, right?
It's crazy busy. I mean, Vegas is amazing how it just like, you can't tell time and how just all it is about keeping you awake.
And then we talked about there, like, I'm always amazed just with the innovation, right? Like that's American capitalism on steroids. Like you think you have a good thing, Wynn? No, you have to come up with something new every 6 months to keep the traffic moving.
I'm always fascinated by the logistics. You got hotels up to thousands of rooms and their entire city unto itself. And I try to watch all the logistics in the early morning as I walk around, like, how does this system work? And then it's multiple hotels in an entire city with just the most amazing logistics system, I think, in the world. And that was Will Wise and I from Ambrose were talking about, it's built in the desert. And so actually people come from all over the world to see how they're able to conserve water at these hotels, because their technology in the water conservation has to be the best in the world for them to be able to just run these properties. But just watching the amount of groups going in and out on a daily basis, I mean, it is truly fascinating.
I had the opposite take on that. I'm like, these guys are like causing water issues, right? Like there's no low flow shower there. You're getting doused in the shower. And I'm sure people are like, have the shower on for 100 hours in their rooms.
Right. But they're recycling that subsystem, but you would think but on that per capita water usage basis, they're the best in the world. So yes, you are still draining, Lake Mead, Lake Powell, and the Colorado River. And there's issues going on right now with that, but like, it's
sorry,
amazing.
Everyone downstream, but
but their ability to use the least amount, you would think, like you said, with high flow shower heads and millions of people, you would think it would be the worst, but like the way they're able to conserve is pretty impressive.
Awesome. Thank you, Jason. Good luck on Pirates today. Hopefully you don't have anyone walking through your background. And we will talk to you soon.
Thanks, Jeff.
All right.
Thanks for listening. If you enjoyed today's show, we'd appreciate if you would share this show with friends and leave us a review on iTunes, as it helps more listeners find the show and join our amazing community. To those of you who already shared or left a review, thank you very sincerely. It does mean a lot to us. If you'd like more information about Mutinyfund, you can go to mutinyfund.com. For any thoughts on how we can improve the show or questions about anything we've talked about here on the podcast today, drop us a message via email. I'm Taylor@mutinyfund.com and Jason is Jason@mutinyfund.com, or you can reach us on Twitter. I'm at Taylor Pearson ME and Jason is at Jason Mutiny. To hear about new episodes or get our monthly newsletter with reading recommendations, sign up at mutinyfund.com/newsletter.
This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Mutinyfund, their affiliates, or companies featured. Due to industry regulations, participants of this podcast are instructed to not make specific trade recommendations nor reference past or potential profits. Listeners are reminded that managed futures, commodity trading, forex trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they're not suitable for all investors, and you should not rely on any of the information as a substitute for the exercise of your own skill and judgment in making a decision on the appropriateness of such investments. Visit mutinyfund.com/disclaimer for more information.